Welcome to The Real Money Show, the number 18778 Silver and the website guildhallwealth.com. My name is Jeremy Wiseman. I'm joined by Jerry Correia, and today we're going to talk about the battle for the next currency system. That's right, the Great Reset. We'll also talk about Russia and their growth in their gold reserves, and of course the moves that they're making on a global stage. Maybe we'll get into some housing and some of the frequently asked questions that we get here at Guildhall. But first, gold so far in the last 6 months is up 10%. We're currently trading at $19.40 an ounce. That's US spot price, $1,940 an ounce. Silver currently trading at $24.67 per ounce, and it is up just shy of 9% over the last 6 months. Jerry, what do you make of the current price action in the market? I would think many people would be a little bit surprised that it's not continuing to move higher, although gold is trading above $1,900 an ounce comfortably at this point.
Yeah, well, the short-term technical outlook right now, it's really trading in a very tight range over the past few weeks since March 14th, Jeremy. The gold price has been trading sideways, and we're creating a wedge, and it looks as though we have built a support of 1915 US per spot, probably downside about 1890, 1880, as I mentioned before. But a lot of algorithm trading. We saw a little bit of a bumpy ride over the last week with the U.S. 10-year Treasury yielding over 2.6%, which is a very dangerous level to be at. That is just an algorithm to suggest that people want to chase the yield, which would mean let's sell gold, but that's not the case. Gold is being bought up like never before. So we're seeing this short-term range condition right now. They're pretty much as tight as they can get, and according to DailyFX, a foreign exchange website and blog, they're saying for now continuing to give the benefit of the doubt to support and the broader uptrend for gold. It looks like it's only a matter of time, measured in a few days at most, that we can see gold on the move again. So this could be the area where you want to consider utilizing some of your loonies, getting into gold right now and converting out of paper into gold.
So there's some noise, right? Some fluctuation, some noise in the market, and gold has moved up, silver has moved up, but we're not breaking new highs. Although purchasing demand for the market seems to be very strong right now. I would say March 2022 was one of the busiest months Guildhall has ever had in terms of the amount of people trying to get into the market. And of course, that was on the back of government overreach and the onset of double-digit inflation. So you can't blame anybody. And I do find that a lot of conversations we have, will sway between, geopolitical issues and different things that are going on. But the main concern that seems to always come back to being number one on the table is inflation at, if government states it at 7, but it's, if you go for groceries or fill up a car, you're probably looking at a 15% inflation. But in terms of this movement that we're seeing right now, let's just stick with gold for a second. We know that Russia has pegged gold to the ruble at, I guess, 5,000 rubles a gram, and which sets a floor on the price. By putting gold onto the ruble, by pegging it, that they instantly put support back into the ruble
immediately, yeah.
which was kind of a masterful chess move to pull out with all of the barrage that the world powers were putting against Russia, that they just said, okay, ding, there's my move, you go next. Now, what kind of floor do you think that actually puts on gold? And what I mean by that is if the paper price of gold were to be pushed down to, let's say, $1,800 an ounce, and it's being pegged at 5,000 a ruble, which is basically like $19.40 an ounce today in US dollars, then you'd end up with an arbitrage. People would say, well, I'll sell my gold, I'll sell my paper, or I'll take delivery of the physical gold that you're selling to me at $1,800, and I'll go sell it to the Russians at $19.40. Is that something that's actually likely to happen? if the price went down? Would the pressure on the Comex and the paper exchanges be that people would say, why would I continue to have this product at this price when I can go around the world and get it at a better price?
No, that's not happening right now with Russia. We have to be very we have to understand what they really did. The ruble was as the ruble was appreciating against the dollar, the floor price that they set was 5,000 rubles per gram of gold, and that was looking more like the current spot price. But when the ruble gold floor was announced, the equivalent cost per ounce was 1509. Since then, it's now about 1880 per ounce because the ruble appreciated.
Okay.
Right? So now it's about 1870, just below where we are today. About $50 below where we are right now. But it's very important to recognize that this is a floor only. It's not a full-fledged gold standard. And as the Russian central bank has declared that this is only buying gold at this rate. Gold is only being bought at that rate in Russia. They're not selling gold at that rate. What they have done is they raised the premium to offer. So it's basically a vacuum, Jeremy. They are vacuuming all the gold that they can get. They're buying at 1873.
So you'd have to be a seller, number one. You'd have to want to be selling gold today at this price in this environment when there aren't really any sellers of gold.
So exactly. So they're only buying nationally that gold at that price. And any international sellers, they actually get the spot price, as I mentioned last week, plus almost 8% premium. So it actually looks very attractive to take advantage of the Russian buying, the Russian bid price. So they're going to be doing this activity from now until June, and then at which point they're going to determine, based on supply and demand, they will announce a revaluation of the gold price, which is going to put tremendous pressure on everything. It's going to put tremendous pressure on the LBMA, the Comex.
Why would it put pressure on them?
Because of the short squeeze, because of the amount of short derivatives that are against the long gold price. As the Russians now are buying gold at a pace that they've never seen. Is it exactly the silver squeeze? Now it's a gold squeeze on the gold derivatives market. So as they continually to remove the gold out of the system, the gold derivatives, the futures prices, the spot prices perhaps can feel the shockwave.
The number 18778 silver, the website guildhallwealth.com. To what extent then could the banks that are controlling the paper side of the market, right, or working in the paper side of the market that is most likely controlling the price of the metal? Remember, price is what you pay and value is going to be what you get. I truly believe that at some point, the dollar will continue to become worth less and gold will continue to become priceless, right? It's going to be how many ounces of gold to buy a house, how many ounces of gold to buy shares in the Dow, right? It's going to just continue to grow. The purchasing power is going to continue to grow. But until that snap happens, do you think that the banks and the controllers of the paper market who are short in this market are now being forced by Russia to get onto the right side of the trade here? Do you think they've got to be sitting there saying, well, we're short this market, but there's a limit now to how short we can go?
I mean,
or are they gonna? Or do you think that they can just kind of work their magic independently and say, no, we've got a captured audience here at the Comex, so we can do whatever we want in the Comex? Of course, for how long? Until people just decide to leave.
Yeah, exactly. Well, you only have value if you underlie what you're pricing by the physical. The Comex has no physical to back itself up. The physical has been leaving, certain ETFs. The amount of gold and silver deliveries that have been coming out of the ETFs have been just enormous. The amount of gold being removed out of the system has been enormous. So this just exacerbates the issue that the Comex has, the LBMA system have. They have to back themselves up physically. Otherwise, they have to capitulate, maybe join that system, or go by the way of MF Global. We remember when MF Global was selling unallocated gold to customers, and then they were on the wrong side of a euro trade, and next thing you know, they couldn't deliver any gold to the customers. So
the idea here is you don't want to mess in the paper market. You don't want to know that you don't have any, that you may or may not have any physical product. You want to make sure that you definitely have physical product, because you don't know to what extent these Comex crooks are what they're capable of at this point in terms of what is this whole thing going to default like MF Global. It's hard to tell how it's going to play out in many respects. But what we do know is for years we've talked about the end game of precious metals, of when the price will just be set free and the value, the price discovery mechanism will be set by the physical market. And that's happening. Mm-hmm. That's starting to happen. It's happening in China. It's happening now in Russia. So it's going to continue to happen, but it does feel that we're really end game now.
Yeah.
Would you agree with that?
100%. Yeah.
I'm looking at you're talking about physical holdings earlier, Jerry. I'm looking at the Russian central bank gold reserves going back in 2008. It looks like they had about less than 600 tons of gold. Today, they're sitting at over 2,000 tons of gold. So I guess the question is what did you think that they were buying this gold for? The number, 18778 silver, the website, guildhallwealth.com. We're going to stick on the topic of the Great Reset. Jerry, we've had, we mentioned earlier that March was an absolutely crazy month at Guildhall. February does not look much different. And one of the big things that people are really concerned about is there's government overreach. I think that faith in governments, especially in North America, are at probably all-time lows. I was listening to something over the weekend that was talking about in the 50s, trust in government was in the 70s%. Okay. Today, it's 20%.
Wow.
Which just goes to show that the trust in the system and in governments that have just gotten bigger and bigger and expensed us more and more reveals itself and results in a lack of faith. Mm-hmm. And now there's a strong lack of faith. And I think at the same time, the everything bubble appears to be bursting. How much higher can the stock market go? Is it supposed to double from here? Another example, I was speaking to a client about that. And it's one of these things like, when do you know when something's topped? If there's no crash, mm-hmm. Right?
That's right.
Just like in our market for gold and silver, how do you know when something's really bottomed? Mm-hmm. You kind of have to see a new high.
That's right.
Then you can say, I think it's safe to say
this is a good buying opportunity. Yeah.
Right. I know in gold, I think gold hit 1150 a few years back. That was like the low, I guess, 2018, 17. And you don't know until you kind of go, yeah, we're up $100. Yep, we're up. Oh, we've retested a new bottom at 1,300, and then you kind of go, yeah, mm-hmm. We've seen it. So it's kind of curious in that sense. It's hard to know where things are at in the stock market and in the economy. Obviously, if prices are up across the board, how are people's margins, companies' margins supposed to improve on that? Mm-hmm. People are going to be buying less. Yeah. So I would just assume that there is a slowdown, that there is demand destruction at some point. So that's got to mean the stock market can't just keep going up. Now, I know that it's obviously completely now independent of the real economy, perhaps, but that certainly seems to be the case. So needless to say, that option might not be there. Not to say that there isn't places to make money. We're not advisors. Certainly there's pivoting, as they like to say in the mainstream financial news media. You pivot to something else. Okay, yeah, that's true. But raising interest rates can't be necessarily good for real estate either. And with inflation at 15%, just leaving money in the bank isn't going to help. And if your game is to then chase yield, you got to really be good at what you're doing to chase 15% yield. Now, that makes it easy for precious metals because they've got an incredible track record of beating inflation. Gold and silver got out ahead of this current inflation that we're seeing. Silver went up 35% over a 2-year period leading into last year. Mm-hmm. And we've made up all of the losses that we took from last year. Remember, why did we go down? Because, inflation was transitory. It was not going to last forever. And of course, they've had to
circle back on that one.
Tiptoe back on that?
Tiptoe, yeah.
Walk back, run back on that. Now they're looking to raise the rates. So holding stuff is what it's going to be all about. There's an unlimited amount of paper, an unlimited amount of ones and zeros and digital, and it's unlimited what you can have that doesn't exist, but there is a limited amount of things that exist. But we can't just have only precious metals in a portfolio, right? So what are some other alternative assets that we could be looking at?
Well, obviously, we have client investors that come to us who are into classic cars, maybe some art, watches, whiskey, perhaps. But for us at Guildhall, we've been doing this since, going almost 20 years now. Natural fancy color diamonds is another option for people to consider. It does have a proven track record, a good history of doing what precious metals have done, and that is being negatively correlated an asset class to the U.S. dollars and to U.S. dollar and floating currencies and the stock market. This is one way to protect your wealth from encroachment, from a government who may want to corner you. This is a great asset class because it not only is a very rare one, but it's concentrated wealth. It's something that you can literally hold in the palm of your hand, have a few tens of thousands of dollars in your hand, and out of Dodge you go. If you have to head out, this is one way to do it in a rare, natural, fancy colored diamonds. And the thing about Guildhall, we take the guesswork out, Jeremy. We take the guesswork out of what you should be going for, how rare is rare, and you do an amazing job of breaking that down.
When we first started, the question of how rare is rare was actually difficult to get forth across to people. But then the Fancy Color Research Foundation came out probably about 6 years ago now, and they've been able to get exhaustive research indexing diamonds, looking at all the dealers and saying, so how many of these come to go through the GIA, the Gemological Institute of America, to see how many of these yellow diamonds are coming through and being graded every year, like what new ones are coming to market. And then they had all the other dealers open their books to say, well, here's what I've sold over the years. And so they could start to say, oh, okay, so, a 1 carat vid yellow, internally flawless. So this is basically a perfect yellow 1 carat diamond of the strongest color. There's a 50 a year for the world, right? That's 500 for a decade. That is a very rare diamond, and that doesn't tell you if that diamond is deep, if it's shallow, if it's well cut. It just says that it's internally flawless and it's a vivid, and it's 1 carat. So it's kind of like dating a little bit. It could be good on paper, but maybe there's no real chemistry once you're really looking at the diamond. But one of the great things about the natural fancy colored diamonds is the lack of volatility. You just don't have to worry about the volatility. Now, if someone was looking at an alternative asset class like a natural fancy colored diamond, should they be thinking short, medium, or long term?
This is generational wealth, and the idea of holding something to pass on to the next generation. It definitely goes against the mindset of many millennials today. Not thinking too far off, but with inflation and the fact that your wages are being eaten away and your expenses are going up, people are being reprogrammed to think more long term. What will things look like 5-10 years from now? So we're being reprogrammed because of all of this, all of the distrust, being lied to about CPI data and things like that. But this is a generational wealth asset class, one that you can pass on easily. So we do recommend holding these diamonds for 10, 20, 30 years and then reassess. Yes, we can find a new buyer for that hold. If you have a holding in diamonds, we will reassess the market and we can find a buyer for that diamond. But unlike white diamonds, there's no list price that determines the value of a pink, for example. Each pink diamond is uniquely different and cannot be commoditized. As with rare art, set rules don't apply. So understanding that this market is just like a real estate market or art market, it has to be categorized in the same way.
Yeah, you wouldn't buy equally in the gold market, you don't buy gold thinking, well, I'll turn around and I'll sell it in a month, right? It is kind of like real estate. You don't buy real estate and think that you're going to day trade it. You don't day trade your house. No. Right? You wouldn't turn around and sell it in 3-4 months. You have to wait till you've covered the cost of doing business, and it's got to make sense. Now with real estate, you can improve it. You can put new money in and improve it. With precious metals and stocks, for instance, the price doesn't change no matter how much you spend. But that is different in the natural fancy colored diamond market, because the more you're looking to put into a diamond, the larger the budget, the more rarity you can get, and that increases the value of it. So it's very different from a stock. You could put $100,000 into one stock, it's all still the same price. But if I'm versus someone who's putting in 20,000, but with a diamond, 100,000 gets you something that much more rare. Mm-hmm. So now, of course, that makes it more of a longer term investment. As the Fancy Color Research Foundation says, these diamonds become investments over time, meaning the longer you hold them, the more you realize it was an investment. Mm-hmm. It's kind of like when someone bought a house in Toronto in the 50s. They didn't buy it as an investment. They didn't think the way people think today.
Correct.
They didn't think, oh, in 30 years' time, it's going to be a $3 million property that I've purchased for $35,000. They don't think that. They didn't think that way. It was, here's my house. I want to live with my family. I'm going to pay the mortgage. Then 30, 40 years goes by and they say, wow, look at what this has done for me. And the natural fancy colored diamond is that way as well, because they really are incredibly rare. They're saying, according to the Fancy Color Research Foundation, that in the next 60 years, there will not be any more mines. Mm-hmm. There will no longer be any new product coming out of the ground. And of course, with the colored diamond, it's 1/10% are colored diamonds. And that doesn't mean that they're investment grade. What does it mean for the audience? What does it mean to buy an investment grade?
Well, the investment grade, we consider what a Guildhall diamond is an investment grade stone. So when we look at diamonds, we look at the four C's. And in this market, you're really, truly investing in the color. So first and foremost, it's about color. What are the grades of color? We start at fancy, up to intense in saturation, up to vivid. The higher you go, the more rare the diamond is in color. Then you get so you try to aim as high as you can get on that upper echelon of color. And that the same strategy would apply for each of the C's. So cut, clarity, carat weight. We aim for the highest possible without compromising on its size. The size does matter in this market. You want to get up to, at least if it's a pink diamond, over a 1/4 carat, close to that. And if it's a yellow diamond, it must be over 1 carat, and it must be internally flawless. So hitting these categories will ensure your experience, will ensure our experience, because Guildhall, we own these diamonds. The family has gone out and procured these diamonds, getting licensed, getting certified. We know what we're looking for. And if it doesn't hit our criteria, we're not going to acquire that diamond.
Now, here's a quote from the Fancy Color Research Foundation, one of the articles that they have. It said, in the last few decades, the category of rare fancy colored diamonds has consistently increased in price. The natural colored diamond segment is considered to be the least volatile among traditional and alternative asset classes. For example, blue fancy colored diamonds have appreciated 241% since 2005. And pink fancy colored diamonds have increased by 366% in that same time period. Incidentally, both categories experienced no significant decreases through that period. And I think that's probably the stronger point here, is it's not so much about the gains, although there are gains in these markets, and we can show examples of, I remember selling someone purchased a 0.22 intense 0.31 intense pink diamond, VS quality. They paid $22,000.
Wow.
That diamond, and that was in,
how long ago?
I think that was 2012-ish, I want to say. And that diamond today is $50,000.
Congratulations.
Right?
Amazing.
So that's pretty amazing. And so we know that can happen. But the more important part is that there's no volatility. You just don't have to worry about it. But it is a longer term hold. That's something to consider. And hopefully the idea is that you don't want to sell it, because if you've held on to something for 10 years and seen the type of gains, at that point, you don't really want to let go. Right? That should be the idea. And to finish off on this segment, I'll take a quote again from this Natural Fancy Colored Diamond article, which you can contact us about. Just feel free to send us a quick email. We'll forward this to you. But they said, here's a quote, that the diamond becomes the guardian angel of portable wealth. Talking about assets to protect your wealth, Obviously, physical assets are a great way to do that, especially if there's a rarity accompanying them. In the last segment, we talked about natural fancy colored diamonds, which are extremely rare. In fact, Jerry, I've been talking with Paul about trying to track down some diamonds recently, and you just can't find good quality yellow diamonds. You can find lower quality, and the prices are okay. Of course, if you up it to better quality, then the prices are going to be much higher. Pink diamonds, forget it. There's nothing to be found. In fact, some of our, what we would call kind of hero diamonds, we can now, that we've held on to for over a decade, we could now actually sell back to a wholesaler at a higher price. Now, a wholesaler, of course, is going to give you the lowest price.
Yeah.
Right? It's going to be like those... What's that TV show when you go, I want to sell this to them, the pawn shop things? They're going to be like, yeah, well, they really try to push it down. But even still, the gains are there. So it's a very positive market if you give it the time. Now, gold and silver are also quite rare in the fact that there's a finite amount. In fact, over the course of March, I think anyone who was trying to buy physical metal could see how tight the market really was. At Guildhall, it was a case of, we don't have the full complement of our inventory. We can't offer you 4 or 5 different types of 1 ounce gold bars. We can only, it's what we have at the time. 1 week it's Royal Canadian Mint 1 ounce gold bars. The next week it might be Credit Suisse 1 ounce gold bars. We just don't have the fullness of the inventory because products moving so quickly. Do you think that's something that we're going to continue to see here? I mean, we've seen it twice in the last 3 years. We saw it happen when COVID first hit. We saw it happen with the silver squeeze. Do you see this continuing as far as not being able to get exactly what you want in this market? You kind of have to say, what do you have? And I'll take it.
Yeah, that's been the trend over the last few years, last 2 years, in fact, since 2020 when the lockdown started to happen and it started to really impact the supply side. And because, we're expecting some deliveries coming in, and next thing you know, they turn around and say, well, it's going to be another week. So the trend is definitely pointing towards, not being able to provide the buffet, as I used to say, of options in 1 ounce gold bars. Sure, Canadians love the Royal Canadian Mint. We understand. But it really doesn't matter. As long as the bullion is LBMA approved, you have global liquidity, global acceptance without exception. Every single major country is moved on, left the US dollar, trading with their own currencies, trading, and what they're doing, they're all strengthening their currency with commodities, whether it be oil, whether it be gold. It's on the back of resources. It's no longer on the back of fiat promises.
Yeah, that's really interesting. I think we should, again, I'll use that word, pivot to this conversation because, up until 2008, central banks were net sellers of gold. And then after 2008, they became net buyers of gold. Now, it'd be my contention that in 2008, the system died. They pumped it up with money. They tried to keep it alive, but it's been on life support since 2008. And then when COVID hit, it gave every central bank carte blanche to just go full hog into print disgusting amounts of cash, of currency, but they can't keep doing that. So now they have to try to raise interest rates and sop up that liquidity. And now it seems like there's this kind of drag race, if you will, for some sort of great reset. Now we know what the WEF version of a great reset is, which is let's get everybody onto digital. You'll own nothing and be happy. And the other side of it, at this point in time, seems very organic and very up in the air in terms of what could happen. How do you see this right now? How would you characterize the current movement towards a great reset? Do you think we'll have a great reset, or do you think there'll be something different?
Well, the great reset that was, titled on the Time magazine cover about, Klaus Schwab's vision of the World Economic Forum's global reset. That's a one world currency, ultimately. That's not the currency that we want. That's not the currency of freedom. That's not the currency of sovereignty and property rights. What we want is national identities. And what we're seeing right now is a movement of furthering national usage of currencies. We have Nigeria using their own currencies. Iran has been off the SWIFT system for years, yet they're trading. They're trading outside it. So the old system, the old guard of the SWIFT system, which we're on as individuals, this is the way that FinTrack was able to expand their encroachment on your bank accounts. This is the old system. The new system, however, it looks to be one that will involve gold, could involve crypto. It could be a national-backed digital currency underlying with gold and other currencies. People today, Canadians, are asking, well, what is money? Let's remind people what money has been for centuries. It must be divisible. It must be durable, portable, recognizable, and scarce. If it is not scarce, if whatever you have in your pocket is paper, it's not scarce. There's a plethora of cash being burned right now. And if you're selling your house and you're denominating your wealth in cash, it's being burnt, as you mentioned, 15% per year. You better get out of that cash. And there's no better way of rolling it into either gold, silver, or natural fancy color diamond to protect your purchasing power today.
The number 18778-SILVER, the website guildhallwealth.com. If you want to get started in physical precious metals, if it's your first purchase and you want to just get your feet wet a little bit, visit guildhallpreciousmetals.com. It's our e-store. Products are constantly changing and moving, but it's a great way to pick up a few 10-ounce bars, maybe a tube of silver maples, maybe an ounce of gold. Just get your feet wet, feel that physical product in your hand, and then I always find that the options start to open because a comfort level is reached and comfort breeds confidence. So remember, it's got to be physical. If you can't hold it, you don't own it. So you can hold physical precious metals, buy it direct from Guildhall, store it in a vault facility outside the banking system, independent vault facility, and it's fully allocated, fully segregated, and you can even do that in a registered account. Again, you're in your registered account, but your physical product is held in a vault outside the banking system. What a unique prospect. Again, the number 18778-SILVER, the website guildhallwealth.com. It's The Real Money Show on AM 640. Hey, listen to this headline. We like betterdwelling.com. They put out good articles and bad articles about the real estate market.
Biases.
Listen to this headline. Canada's housing agency abruptly halted its public real estate warning system. He mentions, quote, Canadian real estate is entering one of its most precarious phases in history. Households will navigate it without the help of the National Housing Agency, though. The Canada Mortgage and Housing Corporation has halted its housing market assessment report. The regular report provided the public with insight on housing market imbalances. The cancellation comes after last reporting Canadian real estate is highly vulnerable, and the central bank begins its tightening cycle. The latter is expected to cool this bubble, which creates a bit of a pickle for the former. End quote. Very interesting that they would kind of stop providing this very integral information to the market, don't you think?
That would suggest that people were using the assessments as a tool or a guide, that this is forward-looking, that the markets will still accelerate higher, and for them to remove that data piece is telling. They don't want to reveal something that may be looking forward-looking in real estate, especially if you're going to be raising interest rates 50 basis points at a time. I mean, this is a very dangerous but necessary step that the central banks are making, both in the U.S. and Canada. There is no way around it. Because of inflation, the only way to quell it is by raising interest rates, and aggressively so. The inflationary data has been this high for far too long, and the fact that the central banks are now only raising interest rates, they're way behind the curve. So for sure, I mean, you have to do that if it's CMHC. You have to, be responsible enough to stop the fueling of an overheated market and potential speculation. I know a lot of our clients have backed away from the real estate investment side. Obviously, you and I both own homes. We do care about the real estate market. We want the health of the real estate market, but we know there was a lot of fueling it, a lot of pumping that was happening. Every realtor that I know, especially some of the ones that are now, in gold, they've stopped doing it. They've stopped saying, this market is overheated. Let's consider gold. I have 3 real estate agents as clients who have advised their clients who are looking to potentially purchase more investment homes to, hey, park some in gold and wait it out, and let's see where this goes. And I thought that was a very prudent move. Unfortunately, a lot of realtors don't do that. Don't offer that type of advice.
I find it just interesting that you just pull the report. They don't even mention it. They didn't even say, hey, this is going to be our last report. They just pulled it. That's it. You're not going to get any more information about this. I always think about this thing on that point, Jerry. I remember being at this art exhibit, and they were showing the Golden Gate Bridge. And apparently, not to be morose, but that's people commit suicide off that bridge. Yeah. And the stats were getting too much, so they just stopped giving the stats.
Interesting. Yeah.
Right? So it's like, this is, if a tree falls in the forest and you're not watching it, did it happen? Mm-hmm. And so now we're all left to our own devices. And maybe this is a good thing. Maybe this is time to, hey, use your noggin. Yeah. You don't have any guidance. You have to look around for yourself and decide for yourself what you see. Maybe we're too dependent on these type of reports, good or bad.
Sure.
To make our own decisions. But certainly it does seem convenient that they would stop this report just as it was started, as the real estate market was starting to look quite vulnerable, which it does seem also irresponsible, because you should give people a warning sign. Agreed. If your car didn't have the overheating signal to tell you, hey, you better stop driving your car, get some coolant into it, you keep driving. What happens? Right? And that seems to be the kind of irresponsibility that's happening here. So I think that we are on our own with regard to protecting our wealth and understanding that. To your point about real estate, though, there is a challenge in moving into gold because there's a cost to acquire physical gold. If someone wanted to get out of real estate and get into the physical gold market, how do you do that knowing that there's pretty high premiums on gold at this time?
The premiums are getting high, and the trend is looking like they're just going to keep getting higher and higher as we progress. So if it is the investors, the clients' goal of utilizing this asset class to get back into real estate, and if they've just sold some real estate and they're parking it into precious metal, we look to kilobars of gold because they offer the most bang for the buck. You're using less loonies to get more gold, in essence. So you're acquiring more gold, and therefore what you're also doing, since this is more of an investment, you need to buy as close to that spot price as possible. We know the spot price is fictitious. It is vaporware, as Paul would say. This market, where it's being, impacted more or less, not so much on the fabrication of the bar itself. It's being driven by supply and demand factors. This factor to the premium is the market factor, which is supply and demand. And as more people are jumping into this market, they're swallowing up the smaller ones. Small 1 ounce bars, even the grams of gold are gone. The 5 grams, the 10 grams. People want to get into the market first with smaller items, and then look to the larger ones.
Yeah, I think definitely go with a more economical product. Maybe also ladder in, so you're holding back a little bit, but also giving yourself a chance to overcome the cost of the first purchase. And the other thing to keep in mind as well is if inflation is indeed north of 7%, well, leaving the money in the bank that's a loss anyway.
That's my argument.
So you might as well take that 7%, apply it to the cost to get involved in the gold market, and at least you have a chance to get ahead. Gold is up 8% in the last 6 months, or was it more than that? Yeah, it's up 10% in the last 6 months.
Right.
So that would be covered at this point. But you mentioned the smaller products, Jerry, and I wanted to ask you, because we have a few moments left on the show here, there's often a debate about can the retail market affect the wholesale market, or the bullion dealer market, and the physical market of the exchanges and the paper markets, the big kind of dealer market. Can the retail market actually have an impact on the price at the Comex?
It's a very good question, Jeremy. Absolutely. The retail side does always put pressure on the wholesale market, especially today, as we're seeing more and more people outstrip the supply with the immense demand. This market will ultimately fall on the back of the wholesale, which eventually falls on the back of the mining. The entire chain gets exacerbated, gets rattled, and the spot price gets exposed. It's already exposed. The paper markets have no gold, have no silver to back it up. The paper to gold ratio, to check out that usdebtclock.org today, it's about 400 to 1. For every 400 paper ounces out there, there's 1 ounce of silver.
And, I think that there's a misunderstanding that somehow Joe Blow on the street who buys 1 ounce of gold for the reasons that we talk about on the show doesn't translate to institutional investor. And I totally disagree. People are protecting themselves against inflation. They want to get their money out of the system just to protect the wealth that they earn. I know institutional investors are going to think the same way. And I know that central banks are thinking the same way because they're saying, wait a minute, if the government can seize Russia's gold or Russia's US dollars in this bank or that bank, they can do it to me. So we're going to start protecting ourselves. I think this kind of leads to a stage where we're going to be hitting a point where it's every man for himself. This is a game of musical chairs, and the music's about to stop. And you need to make sure that you've got your physical assets and you've got your ducks in a row so that you are protected and you're ready. It doesn't matter how this all plays out. Mm-hmm. You're ready to move into the next system. You'll just sell the gold, go into the next currency, or buy and sell using, buy things using your gold, whatever it is, but you're ready. You've protected your wealth. So give that a consideration. If you want to own some physical precious metals for yourself, you can give us a call at 1-877-8-SILVER or go to guildhallwealth.com and learn the different ways you can get involved in the market. That does it for another edition of The Real Money Show. Jerry, thank you so much. It was great to chat with you and great to hear all of your insights. Thank you to everyone for joining us this week, and we look forward to speaking with you next week here on The Real Money Show on AM 640.